Hi there, my name is Jason Ayers, CEO of the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our Portfolio Manager's Brief for October 2021. Well, although the weakest quarter so far, the end of September marked the sixth consecutive positive quarter for global equities since the March 2020 lows, with most of the upside coming from U.S. equities, more specifically growth and defensive sectors. Canadian and U.S. equity markets ended Q3 just slightly higher as September proved to be a volatile month. The S&P 500 gave back 4.7%, while the Nasdaq lost 5.3%, and the TSX ended the month down 2.2%, bolstered largely by the energy sector, which has reached highs that have not been seen since 2014. Comparatively, emerging markets had a challenging quarter, down almost 6%. TINA, or there is no alternative, continues to hold true as despite slowing growth forecasts, equities are continuing to be preferred over bonds, which are down 4% year to date. In general, inflation worries, COVID-19 related news, Fed tapering QE programs, and the related concern over rising long-term treasury rates continue to act as headwinds. However, despite current headlines, September has always proven to be a challenging month for the overall markets historically, while October to December have traditionally performed better, and so far it's been a great start to the fourth quarter. Interest rates in Canada and the US continue to remain extremely low. The Bank of Canada's policy rate is expected to remain at 0.25% until at least Q3 of 2022, according to economic analysts' consensus. And as pictured here, the FOMC, US's central bank, has set a general target rate for 2022 at 0.46%, with hikes expected to take place between Q3 and Q4. Low interest rates should continue to help with economic recovery as indicators such as employment levels in Canada and nominal GDP for Canada and the US improve back to pre-pandemic levels. But with these low rates comes the continued concern over inflation, with both temporary and structural factors causing the sustained elevated price levels. Stats Canada reported a 4.4% year-over-year increase in CPI data in September, up slightly from August and well above the target range. However, to understand the cause for the sustained high levels, we need to look at the components. Some of the largest influencers currently include housing, food, transportation, household goods, and recreation. However, experts continue to maintain that inflation pressures should subside through 2022, which will be the catalyst for the rate hikes expected to begin next year. The largest contributor to the CPI index is housing, accounting for almost 30%. From the start of the pandemic, marked as March 2020, until now, October 21, the new housing price index has increased by 13.3%. Now, this rapid increase in housing prices is caused by a combination of the low interest rates put in place to stimulate the economy and the related curb in spending brought on by the pandemic lockdowns. Just prior to the start of the pandemic, the average Canadian household had a savings rate of approximately 5.1%. Currently, in Q4 of 2021, the household savings rate is higher by 278%, with an average savings rate of 14.2%. Consumers have been saving at an unprecedented level, resulting in more cash to put towards a first-time home or an upgrade by way of a change of address. And as pointed out last month, gasoline prices remain a significant contributor to rising CPI, having been on the upswing since the lows of April 2020, due to a large production gap between supply and demand related to the lack of infrastructural investments into the oil space prior to the pandemic. More money continuing to chase fewer goods suggests that inflation may not be quite as transitory as originally anticipated. But again, analysts suggest that this should come back under control during 2022. On the global front, China remains in the spotlight due to Evergrande, considered to be the world's most indebted real estate developer, and their struggle to meet debt obligations. Now, even though there is likely to be a soft bailout for Evergrande, This raises questions for China's long-term economic sustainability and, of course, the risk of contagion across global markets. For more insight into the Evergrande debacle, please check out our latest research report at www.croftgroup.com. Moving on to our investment mandates. With inflation continuing to be a concern and an increase of interest rates on the horizon, we have shifted much of our equity exposure from growth to quality companies, which will help weather any inflationary pressures that may hit the market. And with the expectation of increased volatility, we have lowered our tech exposure in general while continuing to implement hedged option strategies in a number of our funds to support both capital preservation and consistent cash flow generation. For the income portion of our investment mandates, we have shifted to low duration bonds for now to manage the impact of a rising interest rate environment, which will make longer term bonds a riskier investment. We continue to hold dividend-paying securities that can comfortably maintain their current payouts and, in the best case, can periodically raise those distributions. We also continue to use an option writing overlay to meet the ongoing requirements of clients withdrawing funds for monthly income. Going forward, we will continue to monitor important economic data and rebalance our client portfolios to market conditions accordingly, focusing on delivering strong returns over the longer time frame within your individual risk tolerances and objectives. And as mentioned, for more insights, please check out our latest research report posted at croftgroup.com. And remember, be good to one another, stay safe and healthy, and on behalf of the Croft Financial Group, thanks for watching.